Good day, investors. In this video, we're taking a closer look at Exxon Mobil, ticker symbol XOM. The company reported its latest earnings last week, and there are some important takeaways investors should be paying attention to. Exxon has long been known as a reliable dividend payer and one of the strongest cash-generating companies in the energy sector. But at the same time, the macro environment is becoming more volatile, and that could impact the outlook going forward. So in this video, we'll break down the latest earnings results, take a look at the key fundamentals, then move into valuation, and finally, I'll give you my personal take on whether ExxonMobil stock looks like a good investment opportunity right now. But before we begin, don't forget to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Now, before we dive into the numbers, let's quickly understand what ExxonMobil actually does. Exxon is one of the largest integrated energy companies in the world, and the company operates across three main segments: upstream, which is oil and gas production; product solutions, which includes refining, chemicals, and specialty products; and low-carbon solutions, which is focused on future energy technologies. And what's interesting here is that the upstream business alone generates over 70% of earnings, while the rest of the business helps diversify revenue and stabilize cash flow. So this is not just an oil company, it's a fully integrated energy business. Now let's take a closer look at some of the key numbers from the quarter. So starting with capital allocation, Exxon spent about $6.2 billion in CapEx, while returning roughly $9.2 billion to shareholders, including nearly $5 billion in buybacks. So right away, you can see the company is returning a massive amount of cash. Now looking at the balance sheet, net debt to capital is just 13%, and net debt to EBITDA is around 0.4 times, which is extremely low, and really highlights just how strong Exxon's financial position is. At the same time, the company has delivered over $15 billion in structural cost savings, which is actually more than many competitors combined. And operationally, production in the Permian is now around 1.7 million barrels per day, which is one of their most important growth drivers. Now, before we move forward, it's important to understand the environment Exxon was operating in this quarter. The market this quarter was heavily impacted by supply disruptions and rising costs, and we actually saw some major shifts across the energy complex. Crude prices surged, posting one of the largest monthly gains ever. But at the same time, global crude supply declined by around 10%, and LNG supply dropped even more, down roughly 20%. On top of that, refining activity in Asia was lower by about 10%, and chemical plants were hit even harder, with utilization down by up to 30%. So when you put all of this together, you get a very mixed environment. Higher prices, which benefit Exxon, but also significant operational disruptions. Now let's break down what actually drove Exxon's earnings this quarter. Starting from the left, earnings in Q1 last year were around $7.7 billion. And this quarter, that increased to about $8.8 billion before adjustments. So what drove that increase? First, higher prices and margins had a positive impact. And more importantly, advantaged volume growth also contributed meaningfully. But at the same time, base volumes declined, partly due to divestments and operational disruptions. On the positive side, Exxon continues to deliver strong structural cost savings, which helped offset some of the pressure. However, there were also several headwinds, including higher expenses, Middle East volume impacts, and some timing effects. So when you put it all together, the core business is clearly improving, but external factors are still creating some noise in the results. Now let's shift over to cash flow, because this is really where Exxon continues to stand out. Starting with cash flow from operations, Exxon generated about $8.7 billion in Q1. And if you exclude working capital effects, that number is closer to $11 billion, which is actually above the average of the past several quarters. Now from there, the company invested about $6.2 billion in CapEx, which is in line with their full-year plan. And importantly, Exxon returned roughly $9.2 billion to shareholders through dividends and buybacks. So even after investing in the business, the company is still returning a massive amount of cash, which really reinforces Exxon's position as a very strong cash-generating business and a solid choice for dividend-focused investors. Now let's take a look at what Exxon is expecting going into the next quarter. Starting with upstream, if disruptions in the Middle East continue, production could decline by around 750,000 barrels per day. However, some of that is expected to be offset by growth in other regions. Moving to product solutions, scheduled maintenance is expected to stay in line with Q1, but global throughput could still decline slightly, especially if disruptions persist. And on the corporate side, expenses are expected to come in around $700 to $900 million, along with some seasonal tax payments, which could lead to a working capital outflow. So when you put it all together, the outlook suggests some near-term pressure, but nothing that fundamentally changes the long-term story. Now looking beyond the next quarter, let's shift to the long-term investment case. Because Exxon is very well positioned for long-term earnings and cash flow growth. The company is targeting around $25 billion in additional earnings growth by 2030, and about $35 billion in additional cash flow growth, which is very significant. And this growth is expected to come from higher production from advantaged assets, improvements in product mix, and continued cost reductions. In fact, the company is targeting around $8 billion in additional structural cost savings. So this is not just a cyclical story tied to oil prices. It's a structural improvement in the business, driven by better assets, higher efficiency, and stronger margins. And if we look at Exxon's track record, one of the biggest reasons investors look at this company is its ability to consistently return cash to shareholders. Exxon has increased its dividend for 43 consecutive years, which is a very strong track record. And over the past few years, the company has returned around $150 billion to shareholders through dividends and share buybacks. And this is important because it shows a clear commitment to returning capital. At the same time, Exxon continues to execute on share buybacks, which helps increase returns per share over time. So when you combine a strong and growing dividend, ongoing buybacks, and strong cash flow generation, you get a very attractive setup for long-term investors, especially for those focused on income and total return. And there's one more angle that's really important to consider: how Exxon performs in an inflationary environment. Historically, Exxon has shown a strong positive correlation with inflation, meaning the stock tends to perform well when prices are rising. And if you look over longer periods, Exxon has actually outperformed the S&P 500 during several inflationary cycles. And this makes sense, because higher oil and energy prices typically translate into stronger cash flow for the business. So in that type of environment, Exxon can act as a natural hedge against inflation. And when you combine that with strong cash generation, a reliable dividend, and global exposure, it becomes a very useful asset in a diversified portfolio. So after looking at the earnings and fundamentals, let's take a quick look at valuation and what analysts are expecting. Right now, according to data from Stock Analysis, analysts have a consensus rating of buy on Exxon. The average price target sits around $155 per share, which suggests only limited upside from current levels. But what's interesting is the range of estimates. The low target is around $111, while the high target goes up to $185, which implies a potential upside of roughly 20% on the high end. So there's clearly a wide range of expectations, which reflects uncertainty around oil prices and the macro environment. Now, if we take a look at the stock itself, we can get a better sense of the current price action. Exxon is currently trading at around $154 per share, giving it a market cap of roughly $630 billion. The stock is trading at a PE ratio of about 25, and a forward PE closer to 12 to 13, which suggests the stock is fairly reasonably valued. The dividend sits at around $4.12 per share, which gives a yield of roughly 2.7%, making Exxon a solid dividend-paying stock. And if we zoom out, the stock has performed very well over the past few years, up over 160% in the last 5 years, showing strong momentum over time. And right now, the stock is trading closer to the higher end of its 52-week range, which also reflects that strong performance. So when we bring everything together, Exxon delivered a strong quarter in a very disrupted energy market. Upstream production was up 8% year over year, excluding external impacts. Guyana reached record production, and the Permian remains on track for 1.8 million barrels per day in 2026. At the same time, energy products earnings came in at $2.8 billion, up roughly $2 billion year over year, and refinery throughput increased by about 200,000 barrels per day. On top of that, Golden Pass LNG achieved first LNG, and management remains confident in long-term growth across Permian, Guyana, LNG, refining, and carbon capture. But the bigger story here is that Exxon is showing why scale matters. Even during global disruptions, the company was able to shift supply, increase refinery output, and benefit from stronger margins. So, in simple terms, Exxon looks like a resilient energy giant that can generate strong cash flow in volatile markets while still investing in long-term growth. And that's exactly what you want from a long-term energy investment. So in my opinion, Exxon offers solid long-term growth potential along with a reliable and growing dividend. And while the stock has already had a strong run, I still see this as a high-quality core holding, especially for long-term and income-focused investors. And on pullbacks, this could be a very attractive buying opportunity, because the fundamentals remain strong and the long-term story is still intact. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.